process, to summarize, start from writing the journal book, coming to the journal ledger, then go to the trial balance, and trial balance is divided into income statement, balance sheet and owner's equity. Cash flow is generated by these two documents together. Okay, so cash means whatever income you have earned, whatever expenses you have earned, the balance sheet will tell, are we able to collect the money from our suppliers or not, are we collecting the money from our customers, are we paying to our suppliers or not. Okay, so this is the summary accounting process. Now the next thing is, before how we do the classification. Okay, you have recorded a journal, but and you learn that we have to make the general ledgers, correct? And so, but how you will know which account will go to profit and loss, which account will go to balance sheet, and which account, what are the revenue and expenses. So we normally categorize our accounts into two parts. One is position performance account and one is position account. So performance accounts means our revenues and our expenses. They show our performance. How much money we earn, how much money we spend, performance. Then we have position accounts. They will tell you your exact current position. How much money you owe, how much money you own. Means what is the total value of your assets. So most are asset and liability. So we divide all the category, all the accounts in these four categories. One is performance, revenue, expenses, and your position, assets and liabilities and equity. Okay, on the very major difference between these two is this expense will finish at the end of the year. Means if whatever you accumulate, it will not carry over to the next. If you have made a sale of 100,000 this year, when you next year you start the sale account, the counter will set to 0. Means you will always start with 1. So where this 100,000 will go? Sale will go to profit and loss, right? And profit and loss, whatever is the balance, will go to balance sheet. So it means this $100,000 will ultimately go to the balance sheet within the same year. And balance sheet means your position account are not reset. So if you have a total asset of 100,000 this year, next year when you start, you will start from 100,000. If you buy another, it will be on extra from 100,000, on top of 100,000, not 0. Sales and expenses will start at 0 every year. Every month, if you are, let's say, closing every monthly statement, every month it's 0, start at 0. If you are setting off your financial statements quarterly, it will start at 0 every year, every quarter. Every year it will start at 0. So performance accounts will always reset at 0, and performance account will position account will continue from where they were previous year. Okay, and performance account at the end, finally the balance of all the performance account in the form of profit and loss statement will go to balance sheet, owner's equity. Okay, remember the first accounting equation we did, extended accounting equation we did. Owner's equity is part of your original capital plus whatever you retain from your income statements. Okay, so here is an example. So trial balance will go into 4 parts. One is your assets, your liabilities, your revenue and your expenses. The revenue and expenses ultimately will at the end of the year will go to equity. So finally at the end of the year we will have only 2 things, either assets or liabilities plus equity. That's it. And that will continue to the next year from not from 0, from where we left off. Okay, so these are some examples. So you need to classify which one is performance, which one is position. So what is revenue, performance or position? Performance. Dividends?
Position.
How many say performance, how many say position? It is performance. Receivable? No? Position. Receivables means we are telling you, you don't do like a guessing, no, that either 0 or 1. Receivable means it will tell you how much money you need to receive. So it's not your income or expense, it's your asset. So it's a position account. Long term assets, position. Interest income, performance. Additional paid in capital is position, because the paid in capital will stay there, right? Common stock, position. Interest paid, performance. Cash, huh? Cash. Cash is your position account. Advertising, performance. Tax payable, position. Office supplies, yeah, office supplies you can say either, because this one is not very clear. Office supplies you can have a performance account or you can have a position account, depends on your policy. If you put this as an inventory, it will become your position account. If you charge immediately, it will go as a performance account. Rent, performance. Inventory, position. Suppliers, position account. Yes. So these are the 4 categories that we discussed earlier. Assets are long term assets, cash, inventory, receivables. These are position account. Liabilities, common stock, dividends, supplier, additional paid in capital, tax payable is all position accounts. Then you have revenue and expenses. So these are your performance accounts. So performance accounts will go at the end of the year, we will merge them together and put into common stock as a owner's equity. So becomes a position account at the end of the year. Okay.